Welcome to Module 5 of the Master's Certificate in Technical Analysis. My name is Stu Wisson, and this module is concerned with volume and open interest. Now, we mentioned those way back in the earlier models, that when we're trading we look at a price action, but we also look at the volume of trading and the open interest, which is something you come across in futures and options. And this is a module that now catches us up with the volume and open interest side before we go into more technical indicators and things like that. In this module we also cover more reversal days and gaps, which are just some price patterns, just to finish off looking at the patterns. So here we are with Module 5, Part 1. Now, this is part 1 of Module 5 in this video, and in this video we're going to talk about volume, trading volume. This is applicable to all markets. This is stocks and shares, this is futures, options, whatever you trade, the volume can be used. First of all, what is it? Well, it is a number of shares that are traded in a day. Say we're looking at the daily chart of the number of contracts that are traded. If we're looking at futures and options, you can look at volume for days or weeks. Usually don't look at volume for months, doesn't really give too much, or if anything, but weeks can be useful as well. Basically we look at how volume goes up and down, and that basically is an indication of the amount of interest that there is in a particular market or product. Now you use, or you don't use it as a primary indicator. It's just a secondary indicator that will verify or confirm something which suspects from looking at another indicator or a price pattern. Now, if you remember when we looked at the head and shoulders pattern, we said that the volume goes down each time we reach a new peak, or we go up to a new peak, the volume is less. It's less of a driving force, less number of people who are trading or who are buying and pushing the price up. But generally you should expect that the volume will increase in the direction of the trend. If the trend's going up, then we expect to see the volume rise as people get more enthusiastic about the product. And if the volume drops off, then obviously this means that people are not buying so much, and you may be looking for the trend to slow down. Now here's a graph that shows how we normally look at volume. It's a bit small, but you can see lots of little bars going to the bottom there. Actually it's a bit small because it's automatically scaled, and so it shows one huge volume day and you can see about 2/3 of that across. So it has scaled itself down. But it's still a little bit difficult to look at what the volume is doing. Looking at the bars, trying to interpret them, so traders have invented indicators that are calculated on the basis of volume. And the first one we will look at is on balance volume, or OBV as it's called. And it's down the bottom here. It's shown as a line. Now what the on balance volume does is add in each day's volume, or subtract each day's volume. The way it does that is the computer the way it does this is the computer in this case is the way it does that is the computer in this case is to develop a chart. Sorry about that. We look at the day and say the price is higher this day. If the price is higher, it will add in all the volume that's been traded that day. So if it's a positive day, we're adding that in, and the next day we look at the price again, and if the price is down, it will take away the volume that happened on that day. So it's really a very simple way of doing a trade, and obviously repetitive. It's a great way that we have. It's good that we have computers, so we don't have to calculate this by hand. It was invented around 50 years ago, and I can't imagine that they had much computing power back then to do it. So no doubt they were drawing it on charts by hand. Now, one point that it depends on where you start counting, what the number actually is. In this case we can see there's a number 3 and a number 4 in the left of the on-balance volume part of the chart. It doesn't really matter, because what we're looking at with on-balance volume is if the trend is going up or going down, and what we're looking for all is the price action and the on-balance volume going in the same direction. If they are not, then that's a suggestion that there may be a reversal coming. So that was on-balance volume. The problem with on-balance volume, as you might realize, if the price just goes up a penny, all the volume that was traded on that day gets added on the on-balance volume line shoots up. And if the price went up £100 that day, it's no difference. It would make no difference. You would just get all the volume of that day added on. So we really don't get an idea of weight on how much the price is going up or down. We just have a very simple indicator, which no doubt was complex enough for them to use 50 years ago, which was useful, but is not as refined as it could be. So traders have looked at it afterwards and come up with various volume indicators. One you would probably come across is called the demand index, or the DI, and that basically balances between the buying pressure and the selling pressure that you're seeing on the volume. And then if the buying pressure is higher than the selling pressure, the DI will be a positive number, indicating how much stronger the buying pressure is than the selling pressure, and vice versa. If the selling pressure is higher than the DI, then it will be under zero, a negative number. So that gives you an idea of the buying pressure. Now I'm talking a lot about pressure, and that's really what volume is. It's pressure for the shares to go up or down in price, and that will be the same also when we get to open interest. And getting to open interest, the Herrick Payoff Index, or the HPI, you're only interested in this if you're trading futures or options, when you do have open interest. And open interest is worked into the equation here. I won't go into the equation here, but again this is another attempt to refine so that the index gives you an idea of the selling or the buying pressure, which will be pushing the price, and therefore you can see if it's likely to be pushing it against the trend or not. So in summary, looking at volume, we can say that in principle it increases in the direction of the trend, and actually it can be a little confusing. If it's in an uptrend, you'll find the volume increasing in that direction if it's a strong trend, and also conversely, if it's a downtrend, the volume will increase in that direction too. You also see it said it's a weak market. That doesn't mean that the downtrend is weak. It means that the pricing as such is weak, and therefore the downtrend strongly supported when the price increases in the direction of the downtrend. You have to watch for divergences from price. This is where volume is used. If the volume is going down in an uptrend, then it's a sign that the uptrend is weakening, possibly a sign that the uptrend is reversing. You should be looking for volume to increase in the direction of the trend. In an uptrend, the volume should be going up all the time. The trend is going strongly. As soon as it starts to come down, then you're looking for other signs. Another principle, though, is a secondary indicator. Volume action can precede the price action. So you can see reduction in volume of trading while the price is still trending up. And it's just an early warning. It doesn't guarantee that it's going to reverse, but it's an early warning to look for the trend to stall. Now, that concludes part 1 of module 5. We're going to move straight on to part 2. And part 2, what we want to talk about is essentially open interest. In the first video you've already seen, it's about trading volume. Open interest is something which only occurs in futures and options. You can't have it in any other market, and that's because futures and options have contracts, and open interest is, simply put, the number of contracts which are still hanging out there at the end of the day, and they say to get rid of them, basically. So open interest is something which couldn't be applied to stocks and shares or anything else. It's something which could only be applied to these contracted trading vehicles, futures and options. And one point about open interest is each contract has two partners, two traders, and one of them is short and one of them is long. I don't mean that physically in height, but we'll move on to that now. And so that's just the open interest. The number of open interest is not the total number of people interested in the contracts. It's the total number of contracts which is actually half of the number of interested people. Now, because of the way the markets work, the numbers officially come out a day late. That's just the way the futures markets work. But they do give provisional figures on the same day. But officially it's a day late, so when you look at your charts you just have to bear that in mind. Most of the time it may not make a difference, but the numbers that you see for open interest are a day late. Now, so here's a chart for open interest. If you look at the bottom, we have a vertical bars, the sort of mid-blue, which show you the volume of trading, and that's the same as stocks and shares. And you see the line, the pale blue line, on the bottom part of the chart that is showing you the open interest, and that's going up and down. In fact, you can see that it goes down a lot, lining up with all those red lines in the upper chart. Those red lines are actually settlement date of the futures contract each month, and that's why a lot of the contracts go away at that time. So that's how you would expect to see it. It's best to be superimposed on the volume. I think it gives you a good comparison. Now, because of the way open interest counts the number of contracts, it can vary in ways you may not immediately think of. It will increase if there is a new contract. In order to have a futures contract, it means some traders come in and decided to go long, some other interests coming in and decided to go short. These are new traders. They don't have any other interest in contracts, and so it's a new single contract with traders, one going long and the other going short. But that doesn't mean that's the only trading that's happened, because you can have traders that have already have a position in the futures doing something with that position. If you are a trader who's already got an open long position and a trader who already got a short position and they want to get rid of that, they want to liquidate that. They don't actually have to find each other. The market works it out. But an existing short and an existing long, both liquidating, that gets rid of one contract. So that makes the open interest decrease by 1. And that can stay the same even though people are trading. Simply because someone may sell an existing contract while the other trader buys it as a new contract. Effectively what they are doing is changing ownership of the contract, and it can also work the other way. While someone is selling a new contract and someone else is buying an existing contract, so again there's no change in the number of contracts. Even though there can be market activity, there can be higher volume, but there's no change in the number of contracts. So it's a little confusing until you think what makes up the number of contracts. So how do we use open interest? Well, basically it's the same idea as volume. It's in an uptrend you would expect the open interest to be increasing along the volume while the trend is strong. And if it isn't increasing, it is decreasing, then that suggests that the trend is weakening. And the same applies with the downtrend. Now, open interest shows interest or people interested in a contract or pressure to buy and sell, so it will show that. Now, what you have to watch out for, particularly for open interest, is if it builds up. It's like a stream building up, it's like steam, building up in a boiler. It can build up high pressure, and once it is released, then it creates a lot of problems. For example, you can have a high open interest building up in a sideways trend, but you can have people taking out contracts alongside thinking that it's going to break out upwards, and people taking out the short side thinking that it's going to go down. Once it breaks out one way or the other, then half the participants have been caught out, and they rush to cover their positions. So if the price breaks out upwards, there is a whole bunch of people holding the short side of the contract saying, oops, whoops, we better cover our losses quickly, and now. They rush to cover, which means they buy the long side that pushes up the price. Or if it breaks out on the short side, all those people who took the long position thought it was going up are going to go, we're going to have to cover our losses. and we're not going to sit here and watch the price go down more, so they rush to sell. And what happens when you get a lot of selling? The price goes down. So when it finally breaks out one way or the other, if it's a high open interest, then it will tend to go very quickly. So you have to watch out. A very dangerous situation. So you just have to be on the lookout there. Also, as I mentioned, open interest is available with options. Now options are a little different because options are the option to trade a contract. And it does depend whether you're in the money or not. You've probably heard that. And whether the trade actually takes place. But you stick and use open interest in a similar way as futures. It's still very much a measure of buying and selling pressure and how much interest there is in the market. The other thing you can get with options, you see that here is the pull-call ratio. Because you can have contracts to put, to sell shares at a certain price, you have the contracts to call shares, to buy shares at a certain price. There are two types of contracts in options that you can buy. And someone obviously takes either side of them. So if someone is buying the call option, they're bullish. They think the shares are going to go up in price and they want to lock in the price. They can buy them at a future date in the option. It's the option to buy them at a future date at a set value that they've decided. If there are more puts than people think the market is, then it will go down. They want to be able to sell shares at a set option price because they think they can buy the shares a lot cheaper when the expiration date comes. So put is a bearish, calls are bullish. They think it's a bull market. But basically, if there's a high ratio of calls to puts, it's really an indication that the market may be overbought. People are putting too much enthusiasm into this market, and into the market, thinking it's going to go up. So that is a little bit contrary to how you may think. But then again, if the puts outnumber the calls, the market could be oversold. The next video we'll be talking about will be about reversal days and gaps, and we'll be moving on to that right now. There are a couple of price patterns that we didn't cover in our previous patterns module, so we're picking them up here too, and we'll get straight back onto that right now. So here we are with part 3. This is about reversal days and gaps. These are actual price patterns, but they are in this section because it seemed more convenient. We'll start with reversal days. Now, it may seem a little seem a little bit embarrassing, but they're also known as blow-offs and climaxes. And just remember, we're still talking about trading here. So, blow-offs and climaxes. There are the official terms for reversal days. Reversal days are very strong reversals. A blow-off is a reversal from an uptrend to a downtrend. It's also known as a buying climax, and the bottom reversal can also be known as a selling climax. And we have an example here from the chart we used for open interest illustration. This is just an excerpt from it. This shows a blow-off, a buying climax, and that is the red candlestick here. Now a blow-off is when the trading went higher than it was been before, so as you can see it goes off to a high at 83.975. But the close for the day was lower than the previous close, and again, as you can see, that the bottom of the candlestick is close because of the red candlestick, and that's much lower than the top of the previous one, which is a positive candlestick. So that gives us a very strong reversal signal. It's stronger. The larger the range of trading it is on that day. It's also stronger depending on how much volume was traded on that day. And on this case, as you can see, it reversed dramatically and dropped away like nobody's business. You can also find blow-offs on weekly and monthly charts, and they're actually more significant when you see them there. And the bottom reversal, the selling climax, is an identical idea. I don't have an illustration of that, sadly. Basically, the price drops down during the day or during the week to a new low, but it comes back to a close higher than the close of the previous day. So it's a lot of action, and it does quite often signal that there can be a reversal. So that's blow-offs and climax on reversal days. Sounds a little bit more polite. Gaps. Now, there are 3 types of gaps. Now, you may have heard that gaps usually get filled. A gap is where the stock doesn't trade at that price at all from one day to the next. There's a big price jump, a big jump in the price, and there's no trading values in between. And you may have heard that they're filled sometimes. You hear it expressed as nature abhors a vacuum, as if nature has anything to do with trading. It's not true. They don't have to be filled at all. It's just that the third one, which we'll come to, is likely to be filled. But the first 2 we'll talk about are not likely to be filled at all. They're likely to trade at the values between the 2 days. The first type of gap is called a breakaway gap. This is the start of the trend. If it's an uptrend, this is where the price breaks out from whatever pattern or resistance was holding it back. And the next day it jumps to make a gap. It jumps and starts trading at a lot higher value. So a breakaway gap is associated with a breakout that won't be filled because it's a sign of strength in the breakout. It's a sign that the price really wants to start shooting off from the trend, and you'll usually see heavy volume in that as well. The second type of gap is called a runaway gap or a measuring gap. It's called a runaway gap because the trend is going very strongly. It's gliding along. It's going effortlessly, shooting up or down. It can be either way, but let's just say it's shooting up and the price jumps again. It doesn't trade at a certain range. The next day it just opens higher and keeps going up. So basically the trend is running away. It's also called a measuring gap because traders notice this gap happens about halfway up the uptrend before we get a retracement. So traders will measure how far this is from the breakout to this gap, and then they'll project that value up the gap and say, look, we think it's going to go up at least up to this point, and then you can see more than one it's difficult for me to say. You can see more than one runaway gap in an uptrend, but the use of it for measuring is if it's halfway up, and that one also won't be filled because it's gliding along, it's shooting straight up, and it's a strong uptrend, so there's no reason at all for the price to come back down. The one that will be filled is the third one, the exhaustion gap. It's kind of counterintuitive, but you'll see this when you'll get to the top of the uptrend. The price will suddenly gap just before it falls, or just before the trend reverses. Sort of a last gasp type of effort to try and keep going, and it can't. And you'll see this soon to be filled. In fact, that's one way to prove this is an exhaustion gap, is to see the price come straight back down, filling up the gap in a few days. In the next module, in Module 6, we're going to be talking about moving averages. There's a lot you can do with moving averages. They're a very simple idea, but depending on how many days you average them over and how you analyze them and how you do it, you can see and get signals from moving averages that you can form price targets. It will be, I promise you, a very interesting module. So I look forward to talking to you then.